Welcome back. You're watching Big Deal and we are discussing the key deal trends and also return of mergers and acquisitions by strategics on the deal street with Manisha Girotra of Moelis, India. Now, Manisha, let's talk about the next trends that are emerging. We have seen cement consolidation that is going to continue in South India, as you mentioned. Healthcare deals have been doing the rounds for now a couple of years, and a few of them are live at the current moment. How do you see the other sectors jumping into the M&A bandwagon? Which are the sectors which are now gearing up for a year or two?
So, Nisha, other than the financial sponsors, I see the large strategics which have strong balance sheets basically jumping into and expanding and dominating in the sectors that they exist in. As you rightly mentioned, what happened in the cement sector, you saw what happened in the entertainment sector with Reliance Disney. So I see the large strategics such as the Tatas, Birlas, etc., consolidate their positions in their sectors, as well as you rightly mentioned, enter new sectors. JSW Birla entered the paint sector. Birlas have announced that they want to enter the jewelry segment. So both organically and inorganically, I think the large conglomerates want to play a very large part in this $5 trillion economy growing at 7%. So we'll see activities in the other sectors too, maybe lesser inorganic, maybe more organic, because the opportunities there are probably smaller. The sectors that, as I said before, that will continue to dominate, because 50% of the capital at play is from financial sponsors are the ones which are light on government regulations such as pharma, healthcare services. Financial services, a huge play, both the consolidation by the banks of the fintech companies and other financial services companies, as well as the private equity players wanting to come in and invest in them. Infrastructure, again, will continue to be a large play. The opportunity is huge and will continue to be huge under the Modi government. So you'll see the likes of Brookfield, etc., the large sovereign wealth funds, as well as the Indian strategic players wanting a greater share of roads, ports, etc.
Right. So infrastructure as well as financial services, those two sectors could see much more traction from here on. But when we look at the startup space, Manisha, that had really ruled the roost on the deal street with the fundraising spree and lots of action. Now IPOs are back after a long time in these startup space, the unicorn space. Now with angel tax going in the budget, and on the other hand, a huge anticipation of September rate cut in the US, and probably other central banks also are aligning with that. We are seeing that from Japan, from Bank of England and all. So do you think that the liquidity flush is going to come back? And what is the kind of traction on deals that we are likely to see in the startup space?
So, Nisha, good point. For all the reasons that you mentioned, I think the sector will see some capital coming back. I don't think we will see what we saw 2 years ago when anyone who had an idea could basically go out and raise capital. That's gone. I think people are very clear that if they want to see companies which are demonstrating a path to profitability, if not full profitability, a right to win, size, scale, and only those are the companies that are going to get the backing both in the private and the public markets. You've seen companies like Zomato doing so well, Nykaa, which are demonstrating that they have real operating efficiencies, a path to profitability. Investors are backing those, and that will not change in the next 12 to 18 months. The only IPOs that will do well, in fact, even get a chance to list, are the ones which are able to demonstrate all of these positive trends. The smaller players will either consolidate with the larger players. In the last 12 months, a lot of them managed to raise some level of leverage, etc., or some investments from their existing investors. I think that bit is over now. The ones that are going to basically have good models are either going to consolidate with the larger players or then manage to raise capital through the public markets. But it's not going to be at all as frothy as what we saw 2 years ago. It's going to be very sensible investing in the dominant players, as it should be, as it has been in all the other sectors that you and I have been discussing.
All right. So that correction, consolidation and good sense has prevailed in the startup space, Manisha. But one thing that you mentioned and is one of the biggest takeaways for me, and I would like you to extrapolate on that, is the large conglomerates and the large corporate houses with deep pockets. Do you think that they will play an active role in picking up some of these startups, some of these unicorns, erstwhile unicorns, now having down rounds? And because the flush of liquidity is not going to be or likely to be the same as we had seen in the past, are you presenting such ideas? Are iBankers pitching these ideas? And is there interest on the other side?
So Nisha, in the past, already the large players have made a play in this sector. Tata's went and acquired Big Basket, 1mg, Reliance acquired NetMed. So the big boys have already made some investments in this sector. I think if there is, and including global ones like Walmart, which went and acquired a fabulous company like Flipkart, I think the global players, both in the financial services sector and in the e-commerce segment, will wait for the right opportunities at the right value. And when they come by, I'm very confident that there will be a play there too.
Right. And what about the promoter class, Manisha? And I want to highlight this because a large part of private equity play has been the buyout opportunity in India, which was earlier not available. Then in the middle, it became a norm. And now the private equity is too keen on buyout opportunities. But in a lot of transactions in the recent past, I've seen that the promoters want to ride the wave of next gen premiumization of the value of the company along with the private equity participation. And we have seen some of the deals go in cold storage when that buyout opportunity was not there and private equity did not engage. How are you seeing this scenario? And do you think that there will be some consensus between the promoter class as well as private equity to come to a middle ground on this theme that I think will play out given the confidence that is building in Indian economy now?
Yeah, Nisha, I think it's a good point. I think last 5-10 years, you saw a lot of the large mid-cap promoter families wanting to exit for succession reasons or leverage issues or whatever it may be. And their private equity managed to get clean exits. What private equity in the last 5 to 10 years has demonstrated is that they are able to create a lot of value in the companies they acquired. They put in good professional management. They're able to control the destiny of those companies and, more importantly, the outcomes of exits. And that's the model they like in India. As you said, in some cases where the promoters are seeing greater value, they have no reason to exit. There's no urgency to exit. You are seeing some sort of disconnect, and in some cases there is a path to exit that is being constructed, i.e. the promoter stays on for the next 3 to 5 years and then gets an exit or gets into a chairman role. And some which, as you rightly said, are falling out because of this situation. And in those cases, there are public market monetizations that some of the promoters are doing. So I suspect this will continue to play out. I suspect financial sponsors will continue to want to do control deals just because of the excellent quality of management that's available in India and the kind of strategic inputs they are now able to provide and feel confident. So yeah, I think this is a bit of a tussle that will remain, but most companies are managing to find some near to mid-term solutions.
All right, so solutions there. So Manisha, apart from this particular point as well as equity market valuations, is that an impediment to deal conversion, and are there any other impediments on M&A at this point as you see?
So I think, look, as you rightly said, the public markets is very attractive, is able to take on large exits. But the way I see it, and the way as most of the people on the street see it, is that it's a way to get more capital into India, because you're today able to do these large exits. Delisting norms have become easier, so you can go and talk to strategics who were initially worried about the fact that you couldn't do a minority squeeze out. So short term, you may have some competition, and some of the deals may go into the public markets just because of the private-public arbitrage. But long term, I think it's a big positive. The other big positive, as I said to you before, is just the way the government is partnering with private sector, and that's a key reason you're seeing a lot of the large sovereign wealth funds come into segments which require patient capital. No longer is capital just going into tech and pharma, etc., but people are willing to go and invest in long gestation manufacturing segments just because they see our government as very proactive. So all in all, I think globally, if you speak to companies, they see us as both strategics and private equity. They see us as a country which is dynamic, growing well, wanting to attract capital, both on there is public and private partnership, there is good single window clearances available. So I think we're in the sweet spot as far as global foreign capital is concerned and our ability to attract it today.
So ease of deal making has substantially improved with equity market exits available, in particular, apart from the other economic factors which are really lifting the sentiment and propelling more deal activity. But Manisha, very quick question, the last one, can't let you go without that. Of course, women participation in the transaction space, you have been an outlier in your time and still continue to be. And private equity space in the last few years have been very very focused on improving the participation of women in their firms as well. How do you see it on the M&A front?
I'd like to see a lot more. I think in all the transactions that I've been seeing, it's very heartening to see the law firms. I think they're doing a lot in terms of attracting talent, and you see a lot of women in the law firms negotiating these transactions. I'd like to see a lot more in the banks too. Private equity, as you rightly said, Nisha, is really trying to retain women talent, nurture it and grow it. And so are the banks. But I think for all the reasons you and I have discussed in the past, we want to see a lot more talent come through the funnel, and we're struggling with that.
All right, but that effort continues from your end as well as mine, Manisha. Thank you so much for joining us with your insights. So on the M&A street, it's always a pleasure to speak to you right here on CNBC TV18.
Nisha, it's a pleasure to speak to you.
Thank you so much. And with that, it's a wrap on this edition of Big Deal. Thanks so much for tuning in.